Welcome back to Alpha Recap, your weekly digest of the research that mattered this week. We recorded this after the market close, and we're unpacking the themes, the numbers, and what analysts were actually saying. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. It was a busy week. AI headlines, earnings season warming up, and a lot of valuation dust settling. So, what really stands out here is how everyone kept circling back to the same two ideas: AI as a growth amplifier and valuation as the reality check.
Exactly. And to kick us off, let's hit the top-line framing. Across these notes, analysts said AI is real and it matters, but it didn't mean unconditional re-rating. In plain English, companies can ride AI tailwinds, but the market still expects execution and proof.
Right. And the other thing is the split between the clear infrastructure winners and the enterprise plays. NVIDIA came off as the infrastructure bellwether. Analysts were more bullish there, while companies like Okta and DocuSign got qualified optimism. Upside, but conditional.
Let's go company by company. Start with Splunk. The note came through neutral heading into earnings. The research team basically said there were data gaps in the public set, so they used scenario analysis and Monte Carlo-style stress testing to map outcome.
Yeah, that was interesting. Rather than a hard price target, they said wait for confirmatory earnings or guidance before changing exposure. Practical view. Monitor the earnings cadence and analyst follow-ups. Conservative approach.
Short reaction.
Smart move. Less talk, more evidence.
Okta was next. The AI upgrade story helped its rally. The note cited a mean upside of about 39% to a $100 target after upgrades and AI tailwinds. But the research was careful. The upside is contingent on margins improving and product-led adoption sticking.
So the idea is identity will be central as companies bolt AI into workflows. Identity becomes a governance and access layer. But competition from big cloud and security incumbents is real, and valuation was called out as rich.
Short reaction.
Conditional optimism. I like that phrase.
Bill.com showed up as an oddball this week. Analysts highlighted improving free cash flow despite negative GAAP earnings, and there was explicit takeover chatter in the market. That chatter was seen as an independent momentum driver.
Yeah, so you had two things: core operating trends improving cash generation, and a narrative pushed along by M&A rumors. The note flagged April 30th as a near-term catalyst, with a report due, and said outcomes could be bifurcated around that print.
And DocuSign. The research said DocuSign's big installed base makes AI-enabled contract lifecycle expansion plausible. Revenue per customer could tick up. Price-wise, the stock closed around $46 that Friday, but liquidity and distance from prior highs tempered the view.
Right, so DocuSign gets an AI narrative, but analysts were focused on cash flow and balance sheet health. Improving free cash flow helps the story, but liquidity metrics kept the stance mixed, not a straight all-in view.
Moving over to healthcare, Intuitive Surgical stood out. The price closed around $469, and the price-to-earnings ratio was called out as roughly 58. Analysts acknowledged a huge long-term market for robotic surgery, but near-term headwinds like competition in China and remanufacturing were real risks.
Totally. That is a high valuation already pricing long-term growth. The note was neutral. Platform value recognized, but reminders that modest misses in results could move sentiment materially given that stretched price-to-earnings ratio.
Danaher was similar. Diversified diagnostics and consumables, strong cash generation, but a price-to-earnings ratio of about 38. Analysts flagged integration and mix pressures and said recent price target trims had reduced optionality.
Yep, their steady M&A cadence is part of the case, but execution on diagnostics acceleration matters and can influence the multiple. The stance there was neutral, resilient cash flow, but upside tied to delivery.
Eli Lilly, the Foundeo. Phase 3 data drove the story. Price closed north of $927. Analysts saw blockbuster momentum in GLP-1 treatments and the acquisition that widened neuroscience exposure. But again, valuation was a central tension. A price-to-earnings ratio of about 42 was called out.
So the thesis is growth is present, but pricing and competition in obesity and metabolic therapies could compress margins. Neutral overall because fundamentals are good, but multiples are sensitive to execution and pricing dynamics.
And then NVIDIA. The data center seculars stayed front and center. The stock closed around $202 and had a forward price-to-earnings ratio of about 24. Analysts were bullish, calling NVIDIA the most durable AI infrastructure call in the pack.
Right. The note said NVIDIA's GPUs are central for training and inference, revenue mix moving toward high-margin data center products. But, and this is crucial, they tied upside to multi-year macro stability, competition, and execution. Bullish, but qualified.
Let's step back and highlight the cross-cutting themes. 1. AI is horizontal, but take rates differ. Infrastructure, identity, and workflow companies sit in different parts of that stack and monetize at different speeds.
2. Free cash flow has become the center of gravity for valuation arguments, especially in SaaS and payments. Analysts kept flagging free cash flow and cash conversion as better signals than GAAP earnings for companies like DocuSign, Okta, and Bill.com.
3. Valuation risk was pervasive. Even with good fundamentals, high price-to-earnings ratios for Intuitive Surgical, Lilly, and Danaher mean the market is basically asking for continued delivery to justify those multiples.
4. Near-term catalysts matter. Earnings prints for Intuitive Surgical and Danaher, Bill.com's April 30th report, and any M&A disclosures can create binary outcomes that reprice sentiment quickly.
5. Competitive and structural threats cut across verticals. Remanufactured instruments in surgery, cloud incumbents moving into identity, and pricing in GLP-1 markets could all compress margins even with strong demand.
So the research collectively suggested using scenario analysis and cash flow-centric frameworks. Where data was missing, look at Splunk, analysts ran Monte Carlo or scenario tests instead of relying on single-point forecasts.
Let's pause and explain Monte Carlo and scenario testing in plain terms. Imagine you don't know one exact future, so you build a bunch of plausible futures, best case, base case, worst case, and you run simulations to see the range of outcomes. It's a probability map, not a single prediction.
Yeah, exactly. That's how they handled Splunk. They couldn't rely on a single data set, so they stress-tested revenue and margin paths and looked at distributions of terminal values. More honest than pretending precision.
The cash flow emphasis was one of the clearest methodological shifts. Analysts leaned on free cash flow yields and enterprise value to free cash flow as alternatives to price to earnings, especially for SaaS companies where accounting can mask cash generation.
So when a company like Bill.com shows positive free cash flow but negative GAAP earnings, that tells analysts something different than a straight earnings number. It suggests operating cash strength even if accounting recognition lags.
Short reaction.
Cash matters. Always.
We should talk about the valuation math in conversational terms. When a note says a company trades at a price-to-earnings ratio of about 58, what that means is the market is paying 58 times current earnings for expected growth. That's a lot of expectation priced in.
Exactly. So the bar for disappointment is high. Modest misses in revenue or margin can trigger multiple compression because those companies must sustain strong growth to justify the current price.
Now, on M&A and takeover chatter, Bill.com was called out explicitly. Analysts said that takeover rumors can decouple price action from operating fundamentals, which increases idiosyncratic volatility.
Right. That makes the stock more event-driven. If a deal rumor turns into a filing or announcement, price moves can be large and fast, independent of the longer-term cash flow outlook.
Let's hit the practical implications. What should people be watching in the week ahead, according to the research?
First, earnings and management commentary. Intuitive Surgical and Danaher's Q1s and Bill.com's April 30th print were all flagged as material. Management tones on demand, pricing, and supply chains will be crucial.
Second, free cash flow disclosures. For Okta, DocuSign, and Bill.com, line items like cash receipts, receivables days, and capital intensity will inform whether cash conversion is improving.
Third, AI monetization metrics. For Okta and DocuSign in particular, analysts want to see attach rates, explicit AI revenue lines, or at least proof that AI features are moving revenue per customer.
Fourth, competitive dynamics and regulatory signals in healthcare, remanufactured instruments, pricing trends in GLP-1s, China market share moves. Those can alter the revenue trajectory without an obvious product failure.
And fifth, watch M&A rumor flows and SEC filings around takeover chatter, especially for Bill.com. Those events can be binary and change sentiment fast.
Another theme was methodological transparency. The research flagged where data was limited and used scenario ranges rather than single-point forecasts. That's a more robust way to model high uncertainty names.
Let me play devil's advocate for a second. You could say analysts are being overly cautious and that AI monetization will come faster than they expect. The counterpoint is that execution, competitive response, and pricing all take time, so conservative modeling isn't crazy.
Yeah, that tracks. I mean, when you step back and look at this, the research consensus was basically, opportunity is meaningful, but conviction requires fresh evidence. That's why a lot of the stances were neutral or conditional rather than unabashedly bullish.
Analysts used phrases like pricing in growth and conditional upside a lot. That's careful language, and it's worth repeating. This is informational analysis, not personalized advice. Analysts note data and probabilities.
Let's call out a few contrarian or unique takes from the week. 1. Bill.com. Analysts treat takeover buzz as a real asymmetric catalyst, not just noise. 2. Splunk. The methodical conservatism because of missing data, leaning on scenario work. 3. NVIDIA. Bullish but explicitly tied to multi-year macro stability.
And DocuSign. The liquidity angle was emphasized as a moderating factor on the AI revenue uplift story. That flips the usual growth-first SaaS narrative a bit toward balance sheet health.
Time for a quick reality check segment. 3 quick things to remember from this week.
1. AI helps, but it doesn't erase valuation math. 2. Free cash flow is now front and center for SaaS and payment stories. 3. Earnings and M&A catalysts can be binary and move prices fast.
Short reaction.
Good summary. Clean and useful.
Okay, let's unpack a couple of numbers in a conversational way so listeners have a feel. Intuitive Surgical's price-to-earnings ratio was called about 58, Lilly about 42, Danaher about 38, and NVIDIA's forward price-to-earnings ratio was about 24. Those are the multiples analysts kept referencing when they talked about how much growth is already priced in.
And for Okta, the mean upside cited was about 39% to a $100 target. That's why the research called sentiment more sensitive to execution signals. That type of upside is possible, but it's conditional on the company delivering margin expansion and product traction.
A quick explainer on free cash flow for listeners who want it in plain terms. Free cash flow is the cash a business actually generates after paying for capital expenditures. It's what's left over to pay down debt, buy back stock, or reinvest. For SaaS, improving free cash flow shows the business really converts subscription revenue into cash, not just accounting profits.
And that's why Bill.com showing positive free cash flow despite negative GAAP earnings got flagged. It's a signal that operating economics may be improving, even if accounting lags.
All right, near the finish. What's our synthesis and the takeaways listeners should walk away with?
Takeaway 1. The market acknowledged AI as a genuine growth amplifier, but almost every analyst emphasized conditionality. AI helps if companies execute and monetize it effectively.
Takeaway 2. Valuation still matters. Several firms trade at multiples that assume sustained growth. Analysts said that modest misses could compress multiples quickly for names like Intuitive Surgical, Lilly, and Danaher.
Takeaway 3. Free cash flow and cash conversion have become core validation metrics for SaaS and payment companies. Watch those line items closely. They're likely to be more informative than GAAP results in some cases.
Takeaway 4. Near-term catalysts. Earnings, management commentary, and takeover chatter can be decisive. Q1 prints and April 30th for Bill.com were explicitly called out as binary moments.
And takeaway 5, use scenario ranges, not single points, when you're thinking about these names. The week's research leaned on probabilistic modeling and stress testing where appropriate, which helps manage the obvious uncertainty.
Final reaction.
Analysts were cautious, but constructive. I'd call that a fair mid-cycle posture.
Okay, wrapping up. If you want to dig into any of the specific notes, Splunk's scenario work, the Okta upgrade, Bill.com's cash flow and rumor dynamics, DocuSign's liquidity signals, or the healthcare valuation tensions, hit us up.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, Visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back next week after the next set of earnings and announcements. Until then, keep an eye on those cash flow numbers and earnings beats, and don't assume AI equals instant re-rating.
Yep, see you next week. And remember, this is informational only. Analysts note data and probabilities, not personal advice. Visit stockalpha.ai to ask your questions.